Good morning. I'm Gord Long with the Financial Repression Authority. As part of our ongoing series on investing based on the Austrian School of Economics, I have Alasdair Macleod joining us this morning. Alasdair is head of research for GoldMoney. He writes a blog at financeandeconomics.org on sound money and demystifying finance and economics. Welcome, Alasdair.
Thank you very much. It's a delight to be with you.
Well, I've been looking forward to talking to you for a while. I follow your work. I enjoy it. It's incredibly well done, and you're very perceptive. So I think it'll come out in this discussion for our listeners. But a lot of our listeners may not know your background or be familiar with it. Could you give them an overview?
Yes, I became a stockbroker in 1970, which is an awful long time ago now.
Oh, thank you. We're in the same vintage. I feel better already.
I think we probably are. I mean, since then, I've been an investment manager. I've been a banker. I worked offshore in Guernsey for a while, both as a consultant and also as an executive director of a bank. And I came back to the UK and sort of retired. But of course, we don't retire anymore. Our minds still work, and it's terrible sitting there watching, sort of just doing the crossword or something. You need to do something, and of course, my interest in financial matters basically meant that instead of being a practitioner, I was then an observer, and I wanted really to spread what I believe is terribly important in the financial world to a wider audience. And that basically is to destroy, insofar as I can, this business of printing money as the solution to everything, money and credit. I firmly, it's not just believe, but it's also a question of economic theory. Sound economic theory tells us that sound money actually is a prerequisite for a working market. And that's the message I try and get over. And of course, that naturally brings me into the world of gold, because if you're talking about sound money, by definition, you're talking about something which is not under the control of governments. I then met James Turk, and we started talking. I then started writing for GoldMoney, and GoldMoney has evolved into something which is really quite extraordinary, having been taken over by BitGold, because what BitGold have done is they've, if you like, upended Gresham's law. Gresham's law doesn't apply anymore as far as gold is concerned. It's now coming back into circulation via prepaid debit cards. And I think that's a tremendously exciting development. So I feel I'm very much at the center of things, even though I am, I retired from active trading and dealing and being a banker and have become an observer. So it's wonderful.
Well, your work is meaningful and it needs to be out there, because I think there's an illiteracy that's staggering today of people even understanding what you mean by the word sound money. And certainly when you don't have sound money, you don't have a store of value. And when you can't, and that's why precious metals have historically been a way of a store of value. And as basic as that is, there isn't an understanding
Well,
of it.
I think, Gord, that there is a quote which actually sums up what you're saying very, very well. And that is, this is von Mises writing in his Theory on Money and Credit. He said, not one person in 10,000 understands money. And that is the thing that I feel that I have a mission to try and change. Whether I succeed or not is another matter. But anyway,
it's behind that illusion, if I can call it, that the politicians hide knowingly or unknowingly, and the banks do very well. And I'm not trying to pick on the banks, but it leads to tremendous distortions, which we clearly have: malpractice, malinvestment, mispricing of risk, lack of price discovery, and it goes on. I refer to it as monetary malpractice. But
precisely.
Alasdair, this is a part of a series on the Austrian School, who is a cornerstone of it is obviously sound money, for those who've studied it. How would you describe to our listeners that are unfamiliar with the Austrian School of Economics?
Well, the school effectively started in Vienna, capital of Austria, with an economist called Karl Menger, who was one of the three economists in Europe who came up with the marginal theory of prices. It all goes back to prices, basically. Where Menger differed from the other two was that he appreciated that prices were purely subjective, and something would have a price if demand for it is greater than the supply. I mean, that seems intuitive, which is absolutely correct. But you cannot forecast tomorrow's prices because prices are set basically by the consumer who always has the option not to buy. And I think that's a very important point, which anyone who tries to model by computer, price forecast and all the rest of it actually misses. There is that bit. You do not have to buy something as a consumer. And therefore, this sort of supply and demand thing can vary in ways which are completely unpredictable. I mean, we know this from the stock market. Can you predict tomorrow's price of IBM? No, nor can I. If we could, we would all be terribly rich. But the answer is that prices are entirely subjective. Now, this is very important because what it does is it overturns the cost theory of prices, which is really what Adam Smith believed in, of the theory of cost driving prices, or the theory of labor prices, the cost of labor driving prices. They are completely irrelevant. And if you want further evidence, just look at what happens in the motor car trade. Do BMW sell cars at a price determined by the cost? No, they don't. They work out what price the market will bear, at which they will shift a given amount of stock. And if they get it right, they sell the cars. The cost of production has actually got nothing to do with the price that they set in the market. And we all actually know that if we think about it. But this was Carl Menger's big insight. Now, I think if we go on from there, and I'll try not to be too long about it, we come to something called the law of the markets. Because the reason that you and I work is we go out in order to earn something. The fact that we enjoy it is actually secondary. But we need to transform our skills into consumption. We need to be able to feed ourselves, go and buy the things we want, and also to put money aside in the form of savings for future consumption. So an economy, a free market economy, is comprised basically of people who use their skills to earn, if you like, the wherewithal to buy goods to consume today, and also to put aside something for consumption tomorrow. Now, the intermediary in this, of course, is money. And it's this point that people slightly get lost about what money is. But if you think of it in this way, that all money is it is the temporary storage of someone's labor. By the time he has sold something, if he's an entrepreneur, or if he's just working for someone else, he gets paid in money, which is fungible into goods. And it's the temporary storage of his labor. Now, if you can understand that, you begin to understand why unsound money is actually bad for an economy. Because if government, let us say, in effect taxes the temporary storage of our labor without us knowing it, then we lose out. And this is the truth behind unsound money. The idea that by printing money, by running a budget deficit, which amounts to the same thing, that government can get an economy recovering or generate economic growth is complete nonsense, because what they're doing is they're transferring wealth from ordinary people into the government and into the banks. And I think if you can understand the printing of money in that context, it then begins to make sense. And that basically is a sort of very brief description of the Austrian approach.
Well said, Alasdair. Are there some key tenets in the school that investors particularly need to be attuned to today in this era of financial repression? They need to clearly understand.
Yes, I think, apart from the points I mentioned, understanding prices and so on and so forth, I think one of the things that is desperately important and is actually gives you, if you like, a milestone as to where we are in terms of the relationship between assets and production is that asset prices always refer back to their production. For example, if you buy a house, it will earn a rent. Or, if you're going to live in it yourself, the equivalent of a rent. If you buy some machinery, the value of the machinery, and the only reason that you will pay a price for the machinery is because that machine will produce consumer goods at the end of the day, which have a value in the market. You've got to assess what that value is. And if you get it right, then you're going to make money. But you're not going to pay more than necessary for the machine, because you will look at what the machine can produce in terms of output over its useful life. Now, this applies across every asset that you buy. I mean, even with art, that is harder to value because the output of art effectively is aesthetic value. But with all these things, if you see that the prices of assets in the markets have moved away and become completely dislocated from their underlying productive value, then you know you're in a bubble. And I think that's probably the most important thing to track. So when it comes to cheapness, dearness, that is, if you like, the value judgment that you have to make. And I think that's the insight I would say is probably most important.
You've written a number of outstanding articles. Well, they're always outstanding, but particularly recently. And the one I'm thinking of, I'd like to have your comments on, is the endpoint in financial credit. And I quote, you said in it, since the 1980s, markets have had to adapt to a world of infinite credit. What did you mean by that, and what was the essence of that article?
Well, the essence of the article is that the world post 1970s is a completely different world from before the 1970s. In the 1980s, well, if you remember, we had a run-up in price inflation, which was loss of purchasing power of paper currencies throughout the 70s.
I remember it very well. Yes. I had a 19% mortgage coming due at one point.
Indeed. And I remember in 1974, the British government issued a bond, which was a 15.25 1998 maturity, 15.25%.
Yes.
That was the highest coupon ever issued, by the way. And I think I'm right in saying that Volcker jacked up interest rates in 1980, 1981 to around about 20%. That was the Fed funds, right? Fed funds rate.
It is.
Well, after that, I mean, it was quite clear that rates had been lifted to a point which basically stopped the relationship between business and savers in terms of funding investment and so on and so forth. Basically, it was no longer worth almost any business borrowing money in order to manufacture something. And that was the thing that killed, if you like, the price inflation that we've seen up until the early 1980s. After that, in London, we had something called the Big Bang. And that was when the banks were allowed to take over the securities market. They took over stockbroking. They took over dealings in all sorts of other things. And new markets were created, particularly futures and options markets, which hadn't really existed before. These were all new creations. And they were all given to the banks, effectively. It was that led to the end of the Glass-Steagall Act, separating out investment banking from commercial banking. Why? Because Citibank at that time, which I think was just about the largest bank in the world, pressured the US government to say, well, look, we're doing all our investment banking and commercial banking in Europe. If you want to drive it out to Europe, fine. Otherwise, repeal this damned act, which is basically what happened. And so since then, banks not only had the facility to print credit, they also had the facility to monopolize and control securities markets, including futures. Now, if you can imagine taking those two things together and then using them as a money-making machine, that's basically what we have today. And that's why the world has changed so radically. Now, the endpoint in credit comes, if you like, from the logical conclusion of that development. And that is that on every cyclical peak, the level of interest rates, which collapses the economy, collapses the bubble, whatever it might be, gets lower and lower and lower. And the reason it gets lower and lower and lower is that this combination of credit creation and control over securities markets has basically done nothing more than pumped up the amount of debt. The level of debt has now increased to well over $200 trillion dollars equivalent around the world. So you can see that the whole situation is getting one where the overhang of debt means that the rise in interest rates to stop the economy, if you like, from getting out of control, or price inflation getting out of control, or whatever it might be, is getting lower and lower and lower. And last time round, when we had the Liar loans property bubble in America, I mean, it was a bubble, which we saw elsewhere too. I mean, it was all around the world. It's not just America. The level at which interest rates peaked was around about, I can't remember, 6 or 7% or something. If you draw the line from what was going on in the 80s through to the last one, and also hitting the top of the .com bubble, which was 2000, you can see that the level of interest rates that would collapse the whole system again is probably a rise of no more than 1 or 2 or maybe 3% at the outside from the current levels. So, where we are, the reason we've got zero interest rates basically is you cannot raise interest rates by more than 1 or 2% without serious economic dislocation. And that is why we've come, if you like, to the end of the road when it comes to using credit, extra credit, as the means of deferring the inevitable.
Yeah, most of the major banks are saying even the end game with interest increases from the Federal Reserve couldn't be any higher than 1.5%. Of course, that's a deflation-dependent number, but they're already talking that is the maximum, and it would be a long time before they would get there. But the question is, could we see negative nominal interest rates? Currently, we have negative real rates. We see close to $5 trillion of bonds, sovereign bonds, trading negatively, and the Federal Reserve already talking about the possibility of NIRP. Comments on that?
Yes, I would say, strictly speaking, it is possible we will see negative interest rates. But I would say that is because you cannot rely on a committee like the FOMC to be actually guided by common sense. Anyway, putting that aside,
that's true.
Putting that aside, the effect of negative interest rates will be to throw every commodity into backwardation, if you think about it.
Yes.
So, I have no doubt that negative interest rates would drive up what they call inflation. I call price inflation. I prefer to call it actually lower. It would lower the purchasing power of fiat currency. The problem then is that if you're going to, sort of experiment in that way, what guarantee have you got that you can control the results? And unfortunately, I see that there is no control at all. Again, we go back to Carl Menger and his theory of prices. If you think about the purchasing power of money, it is normally an objective value. But if people suddenly get the feeling that, hold on a minute, we don't want to hold money, we actually would rather buy things we don't need today, but we might need tomorrow, then you'll find that the purchasing power of paper currency will fall uncontrollably. And this actually is what happened in the Weimar Republic in 1923. I mean, you already had a pretty horrific run-up in terms of loss of purchasing power of the mark in those days before 1923, but people finally started dumping money at any cost in 1923, and it finally collapsed in November of that year. I mean, negative interest rates for the one commodity, the reserve currency in which all commodities are priced. I think there's a severe risk that we would generate that runaway inflation, as people would regard it, but actually as a collapse in the purchasing power of the dollar. And it would take every other paper currency with it.
Yeah, hyperinflation is first and foremost a currency event. It's a loss of faith in the currency, and therefore you get elevated price movements. But and it's usually abrupt, short-lived, and very, very dramatic happening. But if the government or the central banks are thinking of the possibility of negative rates, doesn't this mean we need to be in a cashless society, or something we call a war on cash, that is restricting the use of cash so that everything is held within the banking system?
Yes, no, you're absolutely right. And in fact, the chief economist to the Bank of England, Andy Haldane, wrote an article about this, I think about 2 months ago, which actually caused quite a lot of consternation. I mean, he quite clearly said that the only way that negative interest rates could be introduced is if cash is banned.
Exactly.
But we are effectively going that way anyway. I mean, I don't know about you, but over here, cash is sort of less and less a feature of everyday transactions. I mean, you've got contactless payments, you've got Apple Pay and all the rest of it, and people are just sort of flash a debit card rather than carry cash. It is quite extraordinary how cash is being driven out of circulation by financial technology. So it is, in a sense, happening anyway. And I can see that, I mean, if I go to my bank today and I say, and I just sort of turn up and want to take out £1,000, I don't think that would be a huge problem. It could be that, the sort of internal procedures in the bank would instruct the teller to ask me what is the purpose of the money, and I would tell him, well, I'm sorry, I've got a gambling debt or something. They would just have to accept it. But I can see that in maybe a year's time, if I wanted to draw out £500, that they would probably ask the same question. That is the way in which the whole system is going. But you're right. In order to make negative interest rates work, and incidentally, from the regulator's point of view, to control the risk of bank failure, you need to ban cash entirely. And I have no doubt at all that, if you like, is the underlying reason why there is so much emphasis on anti-money laundering, know your customer, and making sure that the proceeds of crime are not recirculated, and making sure that people are not paid for their work in cash and avoiding or evading taxes. I mean, I have no doubt at all that is the underlying reason for it, but it's very, very convenient for the banks to work with that and do away with cash.
Yeah, we're on a road that's a natural road, it seems, because it's for the consumer, the technology. But if all the money is held within the bank, and we saw it in Cyprus, we saw it in Greece. The first thing everybody does with a problem is try and get to their bank, get money out, and the ATMs are locked down. Well, that won't happen anymore. It's all held within the bank, and it's a credit.
Exactly.
So you've effectively stopped the possibility of bank runs. But with bail-ins today, it says the bail-in laws. It says you've lost your claim on what you thought was an asset. So there's a lot of concerns there. Switching gears slightly, the other paper you wrote was on fiat money quantity update, and you're talking. And I have the chart up here now on FMQ. Could you help our listeners with that concept?
Yes. Do they want to be frightened?
We all want the truth.
All right. Okay. All right. Fear is not an issue. Basically, I put together the fiat money quantity, not to represent another measure of money as such, but to try and quantify the amount of money that has been issued in return for the gold that we originally gave our banks, which our banks then handed to the Federal Reserve Board. And the reason for doing this is to try and get some sort of handle on really how much money is not only in public circulation, but also not in public circulation and potentially in public circulation. And the way that the fiat money quantity is therefore constructed is it takes all the cash, it takes all the deposits in the banks, sight deposits, long-term loans or fixed-term loans and so on and so forth do not come into this at all. And I then go further than that. I look at what's on the Fed's balance sheet, which actually belongs to the banks and is capable of being expanded into credit or lent out or taken in, if you like, by the banks and then spent on assets or whatever. And then there are various other factors that you have to take into account because the bank's reserves on the Federal Reserve Board's balance sheet can be changed by things like reverse repos and also repos. So those have to come into it as well. And if you do that, what's interesting is that the growth curve of the fiat money quantity up until the Lehman crisis was running at about 5.8% compound per annum. Since then, it has just taken off. I mean, it looks like one of those scary charts about Germany in 1923. I mean, it really does. Now, what that tells me is that in the very broadest or loosest sense, we have monetary hyperinflation, which at some stage is going to impact on prices in the high street. That's basically what the fiat money quantity is about. I can then use it, given that the link is, our great-grandfathers deposited gold in the banks held it and issued either deposit receipts or their own banknotes. Eventually the system changed and all that gold was moved over to the Fed. We don't know how much is there. It's never been audited. In fact, actually, we do know there's none in the Fed. So it's been sent by the Fed into the US Treasury, actually. So we now have a situation where if that was to be reversed entirely and we went back to gold is money, the quantity of money, the fiat money quantity, is the amount of money that would have to be redeemed for that gold. Now, whether the gold is there or not is immaterial. But the point is that it allows us to adjust the price of gold, say from 1934 when it was moved up to $35. And to be fair, we can also adjust the price of gold by the increase in above ground stocks. Now, we know pretty well how much gold has been mined since 1934. So we can deflate the price of gold by that as well. And we end up with a situation where the equivalent price of gold of those measured in those 1934 dollars is around about $3.40. So that gives you an idea of how cheap gold is, if you like, measured in fiat, in the fiat money quantity. And none of these things are precise, but it just gives you an indication, a roadmap, if you like, as to where we are in monetary inflation.
Alasdair, when I'm looking at the FMQ, and one of the things and it's really concerning me, is something called rehypothecation. That is the pyramiding of collateral and the lack of collateral. I personally believe there's a serious global issue with collateral. And new collateral that needs to be brought into existence. And it gets into something with reverse repos. Can you make a comment on that? Am I off track on that?
No, you're not at all. We tend to think in terms of money supply as just the, money. But the other side of it, of course, is that if the Fed does issue money, it has to do it in order to acquire something. Because it's got a balance sheet to satisfy. And, that what it acquires in when it comes to issuing money, obviously, is US Treasuries. And those US Treasuries are equally the highest level of collateral for a financial system based on dollars amongst the commercial banks. So when the Fed or the ECB, for that matter, or the Bank of Japan goes into quantitative easing mode, what it does basically is it just cleans the market out of that high value collateral, and it does create a huge great problem for the shadow banking system, where this is rehypothecated between buyers and sellers and buyers and sellers and buyers and sellers.
What can we expect? Got a sense?
Well, what it has led to in Europe, and I suspect this is true elsewhere as well, is demand for a scarce amount of this collateral, a demand which has driven the yields on this collateral to ridiculously low levels. I mean, would you really, lend money to Italy for 2 years and expect to pay for the privilege? They got.
To my dear friends in Italy, I don't want to be too strong, but I think the answer is clear.
I mean, on the 2-year bond, I haven't looked at it in the last week or two, but very recently, the 2-year bond was on a negative yield, for goodness sake. And,
Correct.
Italy, in terms of the amount of debt to GDP, I would firmly suggest, with all due respect to your Italian friends, is a bit of a basket case. So, I mean, if you want to see what a market distortion is, there is the evidence.
Alasdair, we're going to run up against our hard line here, but I would really like your feedback and comments on GoldMoney and BitGold and what you see, because you're close to it, what you see what it means going forward.
Yes, I mean, I think the most exciting development really is BitGold. I mean, BitGold, what it does is it gives you a debit card or a PayPal facility, if you like, or similar. And what that does is, when you put money into it, it is immediately transferred into gold at the prevailing price. There's a 1% cost in, there's a 1% cost out when you spend. And the gold is not on BitGold's or GoldMoney's balance sheet. It is yours. It is segregated. You can have it in, I think, up to 11 vaults around the world. So you can select where you store it. I personally have mine in Switzerland. This is a facility which allows people to spend using gold, if nothing else, in preparation for the days when we find that fiat currency doesn't work anymore. And the amazing thing is that this facility is catching on worldwide. It really is. I mean, one of the big markets, which I think is going to rapidly develop, is overseas payments, the remittance market. I mean, for example, you have someone like a Filipino nurse or a cleaner, generally paid not a lot of money, remitting money to home. And if she does it through the banking system or Union Pay or one of those, she's paying something between 6 and 9%. This way, she can just do it 1% in, 1% out. And I think that is a $600 billion market. It is quite...
I think that's a missing point. I don't think people have understood that.
I mean, it's becoming understood, and the rate at which BitGold accounts are being opened is really quite staggering. It's sort of running at something like 100,000 a month. It's the sort of growth rate that Uber and Facebook and all these sort of internet stars, which really caught the public imagination, is growing at a similar rate to those, which is quite remarkable, really.
We have to wrap now. Could you give our listeners a source, your blog, that they could follow your work, and any other places where they could really see the kinds of things?
Yes, I'd be delighted. It's as you said, I'm head of research for GoldMoney, so my stuff is published at goldmoney.com. There's a research tab there, and you'll find it under there. I'm not the only person writing research now for the group, but you'll find my stuff there. Also, it is republished on my own website, which is financeandeconomics, one word, .org, O-R-G. If you look at sites like Garter, they tend to pick them up, and so that can lead you to them. So I think those are the best places to look for it.
I really enjoyed talking to you. There's so many things that I want to continue this conversation with. We're going to have you back again later.
That would be very much my pleasure, Gord.
Pleasure. Talk to you again. Bye-bye.